Good day, ladies and gentlemen, and welcome to the Lodging Juice Live, hosted by Cleveland Research. At this time, all participants are on a listen-only mode, and it is now my pleasure to turn the floor over to your host, Mr. Vince Cipio. Sir, the floor is yours.
Good afternoon, everyone, and thanks for joining us here today. Before we get started, there are a few important disclosures I want to read through. We have 4 participants on today's discussion, all of whom have many years of experience in the lodging industry and are long-standing relations with Cleveland Research. We've conducted regular conversations with these individuals over the years as a way to get a read on trends within the industry. The conversations are helpful to our research process. It's important to note that the views expressed by the participants are their own, and the participants are not being paid in any capacity to participate in today's call. All the topics for the call have been approved by our compliance team, and the intended discussion will not contain any material non-public information. Lastly, today's call follows our notes that were published Tuesday, August 19th, and all the questions for today's discussion are tied to such. So with all that out of the way, excited to be joined here today by Will, David, Evan, and Dan. Welcome, and thanks for being here, guys.
Thanks, Ed.
Sure thing. So before we dive into questions, I want to quickly provide the audience with some background on the speakers for context and give a brief outline of where the conversation's headed. All of our panelists have extensive backgrounds in the U.S. hotel market. David has experience in real estate and is principal of a leading hospitality financing platform in the U.S. Evan is co-founder of a hospitality valuation and advisory firm. Will is responsible for evaluating and executing new development projects at a hotel-focused private equity firm with, I think, about over 100 hotels now. Dan heads up the Americas region for one of the largest hotel brokers in the world. Second, on where we are headed, we will touch on real-time performance trends briefly, but we'll spend the vast majority of the conversation today on deals, development, and lending. So, guys, we did a panel very similar to this with 3 of the 4 of you almost exactly a year ago, and it's always a good time, a little past the halfway point, to kind of get a pulse on where this is at. You know, we go through Alice and then Hunter and NYU, and here we are in August, and a pretty good view of the year, thoughts about how the year might wrap up, what the trajectory is in the next year, so I'm excited to have this conversation. So let's dig into the performance first. And Will, why don't you kick us off here? You look at the industry figures, and RevPAR was negative 0.5 point in the second quarter. July is another disappointment, down 1. In our monthly revenue manager survey that we published last week, we saw second half outlooks continue to trickle lower. And, the average kind of estimate in that survey pointed to a slight contraction in second half RevPAR. So, Will, when you look across that portfolio of hotels that you have insight into, how would you say the third quarter is tracking relative to budget? And how are you guys feeling about the fourth quarter today relative to maybe 30 days ago?
Sure, Vince, and thanks again for having me. Always a pleasure to join in the conversation and talk about the latest and greatest both for us and just to hear from some other folks in the business about what they're seeing. So, I'd say our portfolio of about 100 hotels spread across the country means, unfortunately, when you talk about the national trend, we kind of go along with it. And it is, I think that the numbers you quoted for July were right on where we ended up in July, the second quarter the same, and I'd like to be Mr. Positive and say that things are going to turn around in the back half of the year, but, between looking at just our daily flash reports and looking at our forward look with our operating team, it really is, I think flat could be a win to finish out the year. And, it's a little bit, it's funny, I'm reading some notes that I was going back and forth with our head of revenue management, and unfortunately the word worse shows up a whole lot. They're very short and to the point. I guess they don't like being asked about this so much. But, when you look at it, for us, look at the segments. Group is, flat at best. Corporate is flat at best. And leisure is the one, if anything, that's dragging us down. Our numbers, as we look at the rest of the year, we think leisure this room night growth will be down 2 to 3%. We've been able to offset that on the revenue side a little bit, so we're still looking at kind of flat to maybe a point of RevPAR growth, that'll help, or ADR growth, excuse me. That'll leave us stable year over year, but it's hard to ignore that, the business transient's not doing well, the negotiated channels, and then just leisure, which is kind of the bright spot for the past 5 years, has deteriorated. But with that said, kind of looking at next year, we do think that a lot of the noise of the past year, and to your point, 12 months ago, we had a different president. We were coming off of a lot of, the last bit of stimulus. We were talking about rate cuts. There was so much going on then. I guess we're still talking about rate cuts, but still looking, hopefully, knock on wood, positive next year as things stabilize to allow the room for RevPAR to finally start that positive growth with maybe a couple points.
Got it. That's a really, really helpful overview. And David, Evan, Dan, feel free to chime in here. I know you guys don't have maybe a specific portfolio that you're overlooking, but you have lots of clients that are staring at probably pretty similar numbers. So, anything to add to Will's commentary? There's the buckets of demand, none of which are really shining right now, and then there's the pricing side of the equation. But how are you guys feeling about RevPAR through the second half of this year?
Yeah. Hey, Vince, it's Evan. As you know, in addition to LWHA, we are also partners with Ryan Melliker in our LARC platform. And in addition to shamelessly plugging this on your podcast here, we also have some pretty interesting and unfortunately, as Will said, negative down type information for the rest of the year. Ryan's forecasts are going to be coming out in the next couple of days with a webinar in the next couple of weeks. But overall, sort of the headline is that RevPAR is expected to decrease by 0.7% for all of 2025. This is not the case coming into 2025, the end of 24. To about 99.50, driven by ADR growth of 0.8, but occupancy decline of 1.6%. Looking at a RevPAR that is substantially, like I said, 99.50, substantially lower than anticipated going into the year. So as the year has gone in and gone on, those forecasts have unfortunately turned to the negative. And RevPAR, great metric, right? ADR, things to definitely look at, but really, what does that do to value, and what does that do to EBITDA? So we're also expecting 2025 EBITDA to decline by 5.5%, and values in 2025 to decline by 4%, and then 26 EBITDA to decline a further 1.1%, and values to decline by 3%. So these are not very rosy outlooks, and it's kind of one of those things where you get something that's purely data and unbiased based, but at the same time you kind of hope it's wrong if things turn. But certainly a turn to the downside in 2025 from projections in 24.
So David and Dan, anything to add to that? Obviously, there's a lot of forecasts out there, and they've all moved pretty much lower through the course of the last 6 months. It's a question of whose crystal ball works really that well, even for next year at this point, given that it's been really hard to call 25 RevPAR. But how are you guys feeling about the trajectory of the top line in the industry, and what do you think it's meant for sentiment and appetite for underwriting deals?
Well, yeah, hey, it's Dan, and appreciate the chance to connect with everybody, and we actually agree with a lot of what we've heard. Look, it's interesting, right? It's probably our first almost pure, really rate-driven recovery, right? When we think about other than crawling out of the pandemic hole, it's been a rate-driven recovery, and so we've been relying on rates to sort of carry the water for us for that whole kind of 22 to 24 period, right? And so. There wasn't a lot of room on the demand side. There was, we've sort of been trading down a little bit on the leisure side, trading up a little bit on group and corporate transient, but it wasn't a massive amount of demand growth. I would say, as we talk to investors on a go-forward basis, I think those, either you're optimistic about, kind of the next 3 to 5 years, in which case you're allocating capital into the space, or you're pessimistic and you're not, right? And I would say overall, folks are, over a 3 to 5 year period, relatively optimistic, those that are allocating capital. And if you're allocating capital, you believe that there will be rate cuts, because even though, I've been in this business for about 30 years, historically we are not in a very, very high rate environment. We certainly are something we're not used to, right, relative to the cost of capital. And two, there's been just a lot of noise, our taxes going up, what's going to happen in the regulatory environment, right? So, whether you like what's happening in Washington or not, a lot of these things have been put to bed, right? The big bill, beautiful or not, is behind us, right? So we kind of know what the tax regime looks like. We kind of know what some of the inherent benefits are for real estate that we're inheriting that. We kind of, we have a feel that there's going to be some rate cuts, right? So you have some, an ounce more clarity than maybe we had a few months ago. Certainly Friday's conversation from Jay Powell helped give us a little bit more clarity. So I would say overall people are anticipating over the next 3 to 5 years there'll be some growth. Underpinning all of that is that there's going to be very little new supply, right? So those folks that are allocating capital think, look, I can buy at what I think is a fundamental discount to replacement cost. I do think there's going to be some growth. We'll get into all this stuff, right? But so that's where the people find, that over 3 to 5 years, it's a good environment. Short term, it's a very challenging environment.
Helpful overview there. And, when you think about this, big picture, you're basically staring at flat to slightly down RevPAR for 25 unless something gets a whole lot better or worse in the next 60 days. I think back 10 plus years ago, and there was lots of talk on where are we in the cycle. And it was really this period, 2016 through 2019, everyone kind of just threw their hands up in the air and it was like, we're late innings, but like, who knows how long this can go? It was kind of a thought. And, it's interesting, the commentary today, even from prognosticators, like, you don't hear a lot of the innings talk anymore. So I guess this is for anybody to chime in. What do you guys make of this? Is cycles the right way to still look at this? Does a flat in 25 matter? Is it the beginning of the end, or is it just, a data point in isolation with a lot of specific events that contributed this year, and, next year is a jump ball and anything could happen? Like, what's your take on this, cycle commentary or lack thereof?
This is David, and once again, thanks for having me. These conversations are always fun. I've learned a ton from the other guys on here. Just to comment on that, I think I would argue we're not in a cycle. The typical business cycle is you kind of go through times of growth and then followed by inflation, and then Fed kicks up rates, growth slows, we go through a little dip, and then prime for the next cycle of growth and overheating, et cetera, right? And what we've been through in the past 5 years is just kind of one really unprecedented, but for the last few decades, unprecedented event after the next, between the pandemic and then this kind of massive bout of inflation, kind of the political spectrum lurching back and forth, and now kind of in a place that we're going back to a kind of a resetting of a lot of our international relationships and trade relationships. And so there's a lot of things for which, investors, current investors in their lifetimes have not seen a precedent. So I think, the playbook has kind of been torn up. I think people are having to kind of reimagine, kind of what the business cycle is going to look like, and when we get back to kind of a normal kind of up and down cycle. And to Dan's point, there is a lot more certainty and hopefully leading to stability than we had 6 months ago. And so that I think is very, very positive development. But I think it's really anyone's guess, how much interest rates can be lowered, when is inflation really going to be, kind of down to the 2% range that the Fed seems to still be focused on, and a lot of other, and as the Fed does move rates down, what effect that's going to have on kind of intermediate and long-term interest rates. I think those, particularly in light of massive deficit spending that we're still doing as a country. So I think there's a lot of guesswork out there, and we kind of get into this discussion a little bit more as we go. But I mean, what we're seeing, anecdotally, I think there's just not a lot of market trades to kind of paint a very robust narrative. I think it's still a lot of kind of anecdotal data points. But what we're seeing is values are still coming down. Like investor sentiment is actually, hardening around, there not being a lot of rate cuts or interest rate relief, I should say, that kind of bails out, positions and leads to a lot of capital appreciation.
Yeah, it's a really helpful overview there, David, and a nice segue. Can you make a call on the economy and the business cycle, and then thinking about the relationship between that GDP and what it means for lodging demand. And Will, I want to get your take here. You go back to early April, and I think there was a lot more concern on where the economy would shake out this year. I think people would probably say it's a little better than feared. But it's interesting because RevPAR is arguably worse than expected despite an economy that hung on better than feared. So what's the disconnect? Why is this happening? You look back. Yeah, obviously, there's a small sample size here, but it's fun and interesting to look back over time. And the last 2 years, the last time we 2 years in a row of sub 1% hotel demand growth, which is pretty lackluster demand growth, it was 06, 07. So obviously, not suggesting that 08 and 09 is around the corner, but what do you make of this? GDP, economy hanging in better than feared, but then hotel demand just really struggling to be positive in light of everything going on out there.
Yeah, no, it's a good question, and I guess I point to we talk about historic cycles, and we talk about a cycle, and then you have the GFC happen, and that I don't think the GFC was part of the cycle. Much the same, what are the exogenous events that are impacting this cycle? Like what's happening differently? And historically, for sure, right? GDP and RevPAR are highly correlated. However, are there forces now that are telling people just don't travel? And you might point to, I was on ChatGPT earlier asking some of these questions, and maybe that's something we can point to. Companies looking at other ways to do business. I think you can point to the deregulation that's happening as something that, it can spur certain things of, and this is more the investment side that you get the deregulation, but certainly everything else that our current administration is doing is just upsetting the apple cart for how people regularly do business. And travel seems to be an area that is falling to the side with that. Group felt like it was getting good momentum. Just, I think there were so many bad headlines coming out of the pandemic about what group was going to do, and then people realized that they wanted to travel and they wanted to meet off-site and do those sort of things. But by that same token, you would expect, with the rising tide, things like leisure to continue to grow, and that I question that part of it. Of when we look at the components of RevPAR growth since 2021. How much leisure is dropping so much as it's just resetting to where it would have been falling in line. So I think it's just, not to give a word salad answer of this, but there are a lot of forces at play that make you think that historic cycles are not a good benchmark for why things aren't behaving the way they're quote unquote supposed to.
Yeah, I think that's fair. I think the leisure component is a core issue because it's like you go back over time, leisure is the secular grower. It led lodging demand through the cycle. And you hit that high water mark in 22 when everybody was landlocked and you had all the pent-up. And then it's just been kind of like fighting to be flat 23, 24, 25, it's been a headwind. So it's like that could finally flatten out and return to the secular growth trend. Maybe that helps the hotel demand story, and then that raises questions on share loss of alternative accommodation. So it's a complex question for sure. But let's dig a little bit more. Go ahead.
I think there's something. What you're talking about is something we as an industry need to figure out, which is I think that inflation, we're missing a point. Like if you look at where the first segment hit was at the lower end, right? So inflation hit the lower end consumer in the wallet first. We saw it in a lot of places, and we saw it in the economy segment in hotels. But my belief for most of my career is that Americans view vacations as a right, not a privilege. They're going to take one, right? And so I think we really do need to look at the alternatives as a sector, and I've sort of challenged some of our consulting brethren, right? We have to look at the alternatives for U.S. leisure demand, right? So I think Allianz, the advisor, Allianz Partners put out a thing saying that outbound U.S. to Europe is going to be up 10% this year. I can't tell you. I've literally talked to 10 people in the last 3 weeks that were in Croatia this summer, myself included. And hey, what'd you do this summer? Oh, I was in Croatia. I'm like, it's ridiculous. I had to go for a wedding, but everybody was in Croatia, right? And so there's that piece. There's the disruptors. There's the Airbnbs. There's cruises, which have grown dramatically. There's the all-inclusives outside of the U.S., which have grown dramatically, right? There's all these varying places that compete for your leisure travel. And I think we sort of had this initial, what we call revenge travel, right? These leisure customers that went somewhere because they hadn't gone anywhere. They felt pent up. A lot of people have never been to Europe, and it's very accessible. You look at the rise of nonstop flights to a lot of secondary markets in the U.S. where you can get there from your home city. And I think I don't think we're seeing the data as much as we should in terms of that being real competition for going to the Florida Keys or going to the Outer Banks or San Diego or what have you.
Yeah, no, it's a great point. It's something that we got.
I was just going to say I couldn't agree with that notion. I think the outbound travel versus inbound travel those are definitely significant stats to look at. Listen, we can get into an alternative conversation about potential job losses and unemployment and what that could do to the leisure sector and what that has done in the past. Where U.S. consumer sentiment is today, at a fairly low level. I believe May was at 53.6, which is the lowest level since 1980. So you have lower consumer sentiment, you have fears of unemployment, you have fears of rising rates, right? All at the same time that you also have a part of my language that relatively pissed off international population that due to tariffs, again, it's not political because politically most of you know where I stand and I won't say that here on this call, but it's simply for the fact that Canadians have retracted massive amounts of air travel and so have Europeans. And at the same time, to Dan's point exactly, I know 5 or 6 people alone that have been to Croatia this summer, and Portugal, Spain, Italy, and France are not far behind them, right? And so it's not that you do have an element of the typical domestic traveler, which is pulling back for several reasons, as just mentioned, but you also have the more well-heeled domestic U.S.-based traveler that is saying, I'm going to continue to go overseas as I have in the past, and because I want to, because I haven't been to these places in 5+ years. And that international traveler, which really replaces that U.S.-based traveler, is simply not coming or coming in significantly less numbers. Net international visitation levels on a TTM basis are down over 15% on average. Those are pretty big numbers. And listen, everyone's going to talk about 26 when the World Cup comes to town. But again, that's at most a 4 to 6 week impact, 4 to 8 week impact, and only in specific large markets. So definitely things to think about that are both economically related, but also politically and other source related.
Yeah, we try to put some numbers around this. Basically, if you add up all the cruise, hotel, and short-term rental nights stayed in the U.S., it's about 1 billion nights this year. And it's interesting, that's up about 20% versus pre-COVID levels. And within that, you have, it's basically 150 million nights of growth. And within it, you have cruise that's up 30%, about 15 million nights. You got short-term rentals, which are up almost 50%. It's about 85 million nights. And then the remainder is hotels, which is only up just under 10% and only up 50 million absolute nights. So then you add in the outbound, inbound dynamic, like there's another probably 50 million night shortfall with that trade, with international inbound being, still 15% off and outbound being 20% ahead. So it's like this is part of why that occupancy is still a few points shy of pre-COVID and leisure just isn't kicking. But yeah, it's obviously the focus really is what happens next year. But let's segue over to deals. I know you guys are a wealth of information in that regard, so I wanna unpack it a little bit more. And Dan, maybe high level, you could kick it off for us. And when you think about deal volume, it was obviously muted 23, 24. There was a little bit more optimism on 25. Elevated rates maybe have been digested. There's a little bit more optimism on the top line trajectory. That's fizzled out. Rates really haven't come down. And you have all this uncertainty related to tariffs. Obviously it's been digested in the last 6 months, but there's been a lot of moving pieces this year, and it's been a disappointment versus, the January 1st thought on the deal front. So first half 25 deals were down, I think 20% or so compared to last year, which is a pretty muted year. I remember your commentary, Dan, a few months back at one of these industry conferences you were speaking, and I think you made a point that stuck out to me. I mean, you said, there's no conviction, so people aren't moving off the sideline, and there's no FOMO. And that's really what you need to get this deal machine going again. So it's a few months later. Where are we today with conviction and FOMO? And what's, based on the conversations you're having with large buyers, what's the sense as we move into the fourth quarter of this year and into 26?
Great question. Appreciate it. Look, I think, after we had sort of the, kind of the pandemic catch up, right? There were a lot of leisure assets and when rates were still low, the REITs were still liquid. We had a handful of trades with some portfolio trades, the core points, the watermarks, et cetera. And then rates went up and then, kind of everything froze. Really what we've had since then in the transaction market is we've had a market dominated by the southern half of the United States is really since the pandemic, and by deals sub 50 million, right? So in a long-term trend, smaller deals sub 50 million are typically like a third of the market on an annualized basis. They've been 45 to 50% of the market since, right? So even though by number, we're actually, by number of trades, I look first half of 25 versus first half of 2019, we actually had more trades by number. Just they're small deals, okay? So that's, call it 45, 50% of trades are small. So they're a lot of entrepreneurs trading to entrepreneurs. And then, kind of the heart of the market, which is like $50 to $200 million full service trades. Those are typically 35 to 50% on a given year. They've been sub 35% since 2022. And that's where a lot of that, where the rates have hit. That's where the FOMO is. Typically the FOMO would be, and we just have not seen that. Now, what I will tell you is what we've seen is we saw people try to be sellers of those larger assets. So assets north of, 150, 200 million. In the first quarter. And there was a market. We talked about that in January. We talked about that a little bit in June, but really talked about it in January. And then we had Liberation Day. And so a lot of assets were being priced in and around Liberation Day. And then when Liberation Day came, the market kind of sees that whole idea. Conviction was building, to your point. And then Liberation Day, a lot of the big private, the REITs have been basically on the sidelines, just given where the stock prices are. We get it, right? So if they don't have a ton of cash sitting around and making a market like this, they might as well buy their stock back, as I'm sure a lot of the folks listening today would suggest, and that was what your analysis would say. So the kids aren't playing, and the private equity is like, time out. We'll sit on the sidelines for 60, 90 days. And so that really quelled that. So anybody who really needed to get something done, who was in the market around Liberation Day, pivoted to the financing market, which has remained very liquid, right? Anybody who had time, who really was going to be patient, said, look, we'll just wait. Let's just see what happens. And what we did see was 60 to 90 days later, that capital started to come back in. And a little bit of that sort of FOMO in their mind is, look, I have a lot of capital to put to work. I can buy at a dramatic discount to replacement cost, which you look at, our analysis would suggest that a typical full-service hotel outside of an urban core in a major, top 10 market probably costs $750,000 a key to build today. I can buy at plus or minus 50% discount to cost. I can probably buy it at a high single-digit cap rate. When was the last time I was able to do that, right? And if I believe that the market will reaccelerate, that the economy will reaccelerate, I believe that we'll get rate cuts combined, I think I'll bid. And so what we've started to see in the last, say, 45 to 60 days is that equity come back in. And so they're now re-engaging, they're underwriting deals. Now, of course, the data that's coming out in the last kind of couple of weeks, we'll see what that does. But I would say overall, we're starting to see larger deals find a home in small numbers, to be candid, in small numbers. But I would say the possibility, well, certainly, there's more conviction. That's a positive. And that possibility that conviction will lead to closed transactions that will lead to that FOMO. I think we could see the medium to large transaction market start to recover in 2026. So I would view that as kind of cautiously optimistic again, on the assumption that we're going to get some rate cuts, so a little bit of relief in the cost of capital, and that people will continue to assume that over the next 3 to 5 years we'll have a limited new supply, a re-acceleration of the economy, that people will definitely. And look, the reality is, and that was the point behind the comment about conviction. There's no lack of equity in the world. There's more equity in the world than there's ever been, both broadly and just look at the stock market, right? That will tell you, broadly and for commercial real estate, and within commercial real estate, the hotel sector. So it's all about conviction, and we think conviction is rising, given supply, given discounted cost, given where cap rates are today.
Helpful overview there. Evan, want to get your take. You hear Dan's comments. It's been a rocky year, but hearing a little bit more engagement. It still sounds like the bid-ask spread is wide, certainly relative to historical levels. What's your sense for how that bid-ask may close in the second half of this year, if in fact people are re-engaging? Is it sellers that have to move more? Is it buyers? Dan also flagged the discount to replacement cost. Obviously, an argument from sellers for sure, but just help us think through what's going on with the bid-ask spread and how you think it could evolve here in the next 6 months.
Yeah, thank you. It's so interesting watching the bid-ask spread. If it's a seller, they're saying, hey, we're not selling for anything less than 6 to 7 cap, and then the next day you're talking to the same exact seller, and they're like, we're not buying that for less than an all-in 8.5% cap, all-in post-capex rental, et cetera, and closing. You're like, wait a minute, yesterday you told me you wouldn't sell for anything over a 6.5. I said, yeah, that was as a seller. So you're literally hearing the same data coming out of the same people on a different day. And by the way, this is not an exaggeration. I will name no name, but I've had these conversations on multiple occasions, and I literally laugh at them in their face because they know what they're saying, we know what they're saying, and the reality is that if you think about the hotel space, right? Of course, there are folks that buy in and sell from the hotel space that are not of the hotel space. But to Dan's point, if you think about it, so many of the characters and the players in our space are the same, right? Whether it's, Will's firm, Peachtree. I mean, Peachtree's incredible, right? They're owners, they're operators, they're developers, they're lenders. They kind of cover the whole spectrum. So on any given day, they're selling assets, they're buying assets, and they're financing assets, and each one of them could theoretically have a different ask on the cap rate side all in, right? And as we all know in the hotel space, given the dynamic nature of our cash flows, cap rates are sort of a backed into number based on a discounted cash flow analysis depending upon hold period, 3, 5, 7, 10, whatever amount of years, right? I think ultimately what you'll see is sort of a move to the middle. I know that's kind of a cop-out. I think sellers are still going to want to sell at 7, but they'll agree to a 7.5, 8 all-in post capex, right? And I think that, again, this is very, very high level. I mean, a lot of the stuff that Dan's going to be selling and financing at his level, several $100 million assets or portfolios, right? Those assets could easily trade sub 7, even sub 6, depending if they're trophies, depending if they're super unique, depending, as he said, on the replacement cost side. If something costs $3 million a key to replace and they're selling it at $1.5 million based on cash flow, or $1 million even, those things will happen, and it could happen in cap rates below those sort of overall levels. But again, super generally speaking, I think you'll see sellers capitulate towards the middle and buyers kind of come down a little bit in their expectations. But the buyers coming down will probably be very much in lockstep with the rate decline, right? When you think about it, it's like I was talking to a seller or a buyer. I'm like, how are you buying something at a 7.5? I'm like, what's your debt? They're like, 400 over. I'm like, well, that's 8.5. The last check of my generally, stupid math. And they're like, yes. I'm like, so how does that make any sense? Because I've been hearing the same story for 2 years about, the fact that you can borrow money sub the actual cap rate that you're going in, upside, et cetera. But at some point, post-renovation and post, changing a brand or management company or whatever it may be, there's really not a whole lot of juice to squeeze out of there, especially if you're buying from intelligent hoteliers, right? So again, bid-ask spread, I believe that we'll see a move towards the middle. Everyone will capitulate a little bit. If you think about it, it's really also asset specific, and buyer and seller specific. Do you have a debt maturity? Do you have a CapEx requirement? Do you have a fund maturity? Do you have equity literally burning a hole in your pocket to the extent that if you don't put it out, your allocation will be lost for your fiscal and or calendar year, and you will not get that allocation back the year after because you didn't put it out. These are the types of things that will drive transactions as well, and that could affect the bid-ask spread sort of on an independent sort of secondary, tertiary type basis. So it'll be sort of really interesting to see that. I do think though that if rates come in by 25, 50 basis points over the next, 3 to 12 months, you will see sort of an optimism return to the market that Dan was talking about. People want to transact a little bit more. I do want to talk about the replacement cost side of things. I mean, I think that the replacement cost, sort of argument is relevant in certain situations, but not in all. At the end of the day, if the cash flow of a 25-year-old, 35, 40-year-old box is X and it would cost you $1 million a key to build, but on a cash flow basis, whether you use a 7 or an 8 or a 9, it's still, worth a fraction of that, a third, a quarter, a half, whatever. Who cares what it costs to replace it? The only insofar is that it'll cause you not to build. I think the replacement cost model is definitely pushing some developers to move towards an acquisition model rather than a development model because building has become so expensive. I mean, we're working on a couple of projects right now with over $2 million a key construction and development and redevelopment costs, right? When you think about those numbers, those are astronomical. So if you could buy a really good resort property with a decent in-place cash flow, for 20, 30, 40% off of those numbers, sure. But I don't know how much it is relevant to actual value versus a build versus buy. I mean, yeah, you could say there's long-term value, but the reality is the cash flow is king, and that's really what's going to drive transactions and value ultimately. But it's nice to put that in a book and sell off of that. Sorry.
I think to Evan's point, But to Evan's point, the key thing is it's like a barrier, right? It reinforces the fact that someone's probably not going to build next door anytime soon. That's really the big thing about discount to cost.
Totally agree.
Give you that supply.
Totally agree.
Yeah.
Right.
Yeah. And just to connect to this conversation to what you said, Vince, about kind of there's been 50 million room night growth in the U.S. hotel market since COVID, and yet performance has been pretty flat. And I think a lot of that is because new supply has soaked it up, right? I mean, the threat to the business long term is new supply, because you can't have too many hotel rooms with not enough demand and have any kind of pricing power whatsoever. So I think to your guys' point, like I think replacement cost is relevant, but largely to like what we're seeing, like limited flex service hotels, very few places justify new, kind of large full service hotel development. But I want to make one comment, if I can, about Evan's point about, or just a question about bid ask. Personally, I think the ask is going to change before the bid does, and that's because the math is not changing as fast as investors, as buyers want it to change. And the reason that an owner can be a seller at one price and a buyer at the other, and say it, like back to back, is because in the one case he's doing the math, and the other case he's not. Right? When you're a buyer, you're like, how do I make a return given the cost of debt and my expectations of future growth? How to make a return justifies making an investment. And the math is just isn't changing. And short-term rates are going to change. I mean, one way or another, Trump is going to figure out how to get short-term rates down. Whether or not that changes long-term rates and/or increases risk premiums or anything else that has an effect on how people borrow on a permanent rate basis, like 5 and 10 year money, like that remains to be seen. There's a lot of different opinions about that. But I think if values are going to go up, one of three things really need to happen. One, we need to have RevPAR growth or getting a strong expectation for that. Two, we need to have the cost of capital really come down and not just the short end of the curve. And three, we need, just optimism. We need like a burst of hey, we've gotten through the rough patch and the future's really bright. We saw that at the beginning of this year. And, Dan mentioned on kind of the equity side, we saw it in the debt space. Like, lenders were really leaning in. Cap rates were compressing. Interest rate spreads were compressing. Lots of increased allocations. And similarly at Liberation Day, kind of the music stopped for a period of time, and things have largely kind of come in, but it's not the same level of just kind of go optimism. The one thing I do think that reducing short-term rates will do, will help values in kind of a more meaningful way, is it will reduce everyone's money market and savings rate. Right, because there's a lot of investors out there that are like, hey, I'm thinking of a 4.5% risk-free yield if I just keep my money in the bank or a money market account or in short-term treasuries. Why would I take equity risk for an 8% return? Why would I take equity risk even for a 10% return? I'm happy to stick with my 4.5%. When that math changes and now you're getting 2 points on your liquid assets, that will push more money into the risk space, I think.
That's a good point. Will, I want to get your take here. There's a lot of talk about owners like you and wanting to sell at this and buy at that, and what's your perspective on everything that Evan and David have just discussed?
I mean, certainly we are no exception. We want to buy at X and sell at Y, and
there you go.
So everything they said is right. So that's all I got for you. And I think that we kind of went down this road a little bit, that a buyer is laying out a business plan and they're figuring out what the buy needs to be at to make their business plan work and to make their return. The seller is looking at their history of owning the asset and saying, believe it or not, 5 years ago when I bought this hotel, I wasn't exactly right about how things went. Whether it was things in my control or out of my control. I'd say over the past 5 years, probably out of my control is the one to pick. But I mean, I want to sell at a 6 cap. That's because that's what fits my underwriting. That's what fixes everything that happened in the past. The fact that if everything had gone to plan, an 8 cap would have worked for me. But from where I stand today, like, it just doesn't. I'm selling at a lower number to get this thing balanced out. Now, we talked a little bit, and Evan actually saw all of my talking points about what's going to motivate you to motivate a seller to actually sell. Whether it's the conversation we have. It's okay. I mean, it just means we're on the same wavelength, which either makes me feel really good or really bad. I'm not sure.
I'd be afraid if I were you.
Yes, I'm going to crawl under my desk after this one. But we look at every week. With 100 hotels, we have to break it up. But every week we go through about a quarter of the portfolio and just talk through strategy on what we're going to do. And, I will say there are certain parts of our portfolio where fund life is the motivating factor. Like, we're going to need to sell just to close this out. We're thinking about recycling investors' capital. At a certain point, some investors may say, just give me my money back and I'll give it back to you. Just don't lose it. That's the goal. I think we have the benefit from the borrowing side of good bank relationships, so we don't get that pressure to make decisions. But we certainly are with some of our longer tooth investments looking at the CapEx side and saying, do we want to be the one who puts these additional dollars in? And are we willing to stomach the fact that I can't get that 6 cap that would have solved my problem on my underwriting? I need to just do an 8 because it's better for my future anyway, just to do so. So just a couple of different ways that we think about it of, don't fall in love with your real estate, right? But, you also have to say that, like, I've got to cut bait at some point. And not every investor has the luxury of that. Smaller ones certainly don't. Ones that don't have great relationships with their capital, who know that not getting this right could mean I'm not getting money for the next deal. That could get in your way. But that's just really when we look at it on a day-to-day basis. We look at each one individually, look at all of those factors that are coming in. And, I will say increasingly, from 2 years ago to now, being much more realistic about if I'm going to sell, I just kind of need to do it. That ties into, I think, the rate discussion we were getting into as well. Everyone's focused on Fed funds. That's great for to David's point, that's great for your money market, except it might spur you to go somewhere else when that goes down. But how much is that really going to affect long-term borrowing? And even though, we're SOFR-based borrowers for floating rate debt, by and large, real estate is a long-term asset. And you have to think about what's going to happen with those dollars long-term and those interest rates.
Right, and that's going to be the point, right? So if you look at, hotels are a 5 to 7 year old, right, kind of constant cycle asset for most of the market, not all the market, for most of the market, right? And so if you think about hotels, kind of the cost of equity generically is it's a spread to the risk-free rate. So if you use a 5-year, right, you're probably if you're an allocator, you're probably looking at, okay, there's a spread relative to the 5-year. We're probably in a better environment than we've been in a long time to be able to underwrite that you're probably going to get the benefit of declining 5-year rate, right? If you hold the spread constant. So in other words, you're going to get cap rate compression. You could argue, I'm not saying you'll get it, you could argue cap rate compression on exit today, more so than you could for the first time in a very long time. I'm not saying it's going to happen, but I would say that, again, go to the point. If people are motivated to allocate capital into space and you believe that rates are going to come down, part of the benefit of that is that you're going to believe, again, and Bill and David both raised good points, is what really does happen with longer term rates. But if the 5-year comes down, you believe that the 5-year is a good marker for hotel equity relative to that plus a credit spread, a risk spread. You could argue yourself into a lower exit cap than we're at today, which gives you some running room to underwrite pricing.
Yeah, it's a great point, Dan. And David, maybe you can weigh in here. I do think historically as you do see cap rate compression as interest rates are cut. But when you think about that risk premium and spread, do you think what's the chance that cap rates don't change a whole lot even as rates move lower, and that risk premium widens a little bit in light of, the performance out there on the top line and the bottom line isn't anything to be too excited about right now. So I wonder if that's something that needs to be factored in. Any perspective there, David?
Yeah, spreads are actually pretty low right now. And so there has been a good amount of compression, and the lenders I talk to, kind of the capital markets focused lenders, are a little more concerned, that there's something that's kind of negative news that blows them out versus kind of a continual grinding them in. But I think barring something, some sort of shock, I think spreads are about as tight as we're going to see them in the cycle. We are, that said, we are seeing quite a bit of divergence in credit spreads from the banks. So, some pretty wildly different. kind of numbers on the same transaction from different banks, just depending on how they're motivated and kind of how their existing portfolio is doing and a whole bunch of other factors that it could be in some cases 200 basis point swings between the cost of capital from kind of one bank to the next on the same transaction. And there is a huge advantage to relationships in this environment to kind of earn kind of lower spreads. And frankly, a lot of the trades that we're seeing of stabilized assets are being kind of done with relationship kind of lenders that can really create a lot of equity value for their clients by giving them 150, 200 basis point, 100 to 200 basis point kind of spread compression just based on the relationship. And it's hard for another buyer to compete if they're having to pay a lot more for the same debt.
What are you guys seeing on the financing side? I remember, I think earlier this year there was lending loosening up and spreads compressing, and then Liberation Day occurs, obviously caused some panic, but it sounds like lenders have gotten kind of back in since. But like, where are we at today with what you can see on the financing side for a stabilized asset? Anybody have anything recent for a frame of reference?
Well, we're in the market with a bunch of that stuff, kind of all the time, and generally leverage is being priced certainly by the capital markets, and you can be in the fives for a 5 or 10 year transaction if you're low enough leverage, and on the other end of the curve, if you've got you've got a kind of heavy lift business plan bridge financing need, you could be paying as much as 500 to 600 over SOFR, so you're pushing 11%, and that's a crazy wide variance of cost in different kind of different risk profiles and different durations. So there to Dan's point earlier, there's plenty of liquidity for debt. It's a question of what does it cost, and the cheapest capital is certainly for kind of lower leverage deals, either capital market execution, which means CMBS or life company, or doing it with a bank. And the cost of capital rises very quickly when you kind of go up the risk spectrum.
What I would say, Vince, is look, I mean, all the cylinders are firing in the engine, right? So there's a solution for most things today, right? Set aside construction, right? And construction, there are solutions for construction, but I would say, the market's in relative balance, right? CMBS is highly active. Again, a lot of things are deal and sponsor specific, but CMBS is highly active. The bank market, when SASB came back in, right, and did a lot of big deals over the last 24 months, that really helped clean up the money center bank balance sheets. They were on the sidelines, right? Like Wells, B of A, but for special relationships, JPM, they weren't active. They became active again because SASB helped them clean up what was stuck and hung on their balance sheets. The debt funds are very active and very diverse in what they'll do, right? Life companies are back in the market, albeit, lower leverage, better sponsorship, a lot of fixed rate, but they'll do fixed and or floating. So, I mean, I will tell you, if the equity market wasn't as good and as diverse and as active a space as the debt market is, people who do what I do for a living would be very happy.
It's a great point. And you mentioned new construction. We'll spend our last few minutes there. Will, I know you've been active with some new builds. What have you kind of seen on the construction side? What's the thinking behind breaking ground versus buying an existing asset in light of all the conversation we've had earlier in this last 55 minutes?
Yeah, no, it is. If you're an existing owner, you're probably happy that it's not. Happy the supply pipeline is where it is. I remember 2 years ago we were debating. I think it was you, me, and Matt were talking and debating if the under construction pipeline would drop under 120,000 rooms. If that'll ever happen, and I think we're under 90,000 right now, if I read the number right. But it just goes to show that there's just there's so little construction going on, and what that's done for us is I think one where we're seeing, there's a bucket of opportunities which are just, it is infill that's really hard to get approved. And so if you can kind of hang in there and get through the entitlement phase and these certain sub-markets, bigger markets, you can do really interesting infill deals. We have a dual brand Marriott in a Texas market like that where the entitlements took 5 years to get. And it's just the demand story could write itself. But on the other end of the spectrum, what we're seeing is that there's a lot of, I would say there are smaller markets out there that think like a Raleigh or somewhere like that are finally starting to see meaningful population growth, which has meant that kind of their suburbs, so these suburbs of tertiary markets, are starting to get enough kind of critical mass that supports building a hotel where maybe the existing stock is that Econo Lodge that was built 40 years ago. And so that's where we're starting to see that, to be able to go in, whether it's with a Home 2 Suites or a Live Smart or something along those lines. It's a deal that we can make pencil. But certainly, going to Hotel Row and trying to build another Hampton Inn does not make sense in many places. We've been Go ahead.
Go ahead. You bring up a good point. Yeah, go ahead, Will.
No, I want to hear what my good point was.
Well, the brands are all about net unit growth, right? And key money's part of that, rolling out new products that fit both the consumer need as well as what works with the developer and makes economic sense that could pencil. So it's just ironic that you bring up that, hey, it's harder to slide another Hampton into Hotel Row, but hey, premium economy, quasi extended stay, it works in more markets, easier to pencil. And it kind of works on both fronts. Like, is that something you believe in, or you're just cherry picking an example? And we have another minute or two if anybody else wants to weigh in on this subject of where development's going and what bullets brands to fire to help catalyze it.
Yeah, I'll let other folks weigh in too, but I'll just say briefly that the brands have done a really good job to get the analysts focused on net unit growth, to the point that, as a developer, you don't want to rely on key money, but it's probably going to be essential to cover the last little gap in the deal. So, not only, you don't underwrite it from the get-go as having it, but that that's a place you can push a brand. And if you are getting a project close, ready to go, you start to hold more of the keys. And that's where we've, I think, we as a platform have been successful getting key money into our deals, in part because the brands know that that's how they're going to continue to push what's pushing stock prices.
Yeah, I definitely agree with the stock price situation for the brands. I would say this: it's surprising on our side that I would say that. So people always ask us what's sort of your split of business. As most of you guys know, we do valuation, market feasibility work is our primary core. So we do 12 to 1,500 appraisals, market feasibility studies a year. I would say right now you're looking at something like 70-20-10. 70% of our work is for refinancing, 20 to 25% is for market and feasibility work, and call it 5 to 10. 70 could be 65, right? 5 to 10% is for transaction-related, actual investment sales, things trading hands right now. And so the point in that is that we're seeing way more market and feasibility work than I would think, given where we are from a construction cost as well as just overall, overall metric perspective, and of course the cost of capital. Both the cost of construction and the cost of capital are majorly prohibitive in many cases, right? To building a new X versus an existing one. And so it's surprising, but we're seeing a lot of it. So there's a lot of interest in building. I still think that supply will remain below 1% on a 5-year case going forward. And existing hotels are in good shape. In terms of the brands, totally agree. Brands are throwing. We're seeing for full service either managed, even franchise operations. And again, no names, no situations, but we're seeing significant resources via capital investment in terms of key money, in terms of some sort of financing assistance, whatever it may be, even in some cases true equity in deals. in order to ensure that the pipelines for the brands remain robust and that that they do not lose existing keys in existing markets. So throw out in Atlanta, if brand Y has 1,000 keys, they can't go below 1,000 keys for many reasons, or they don't want to, I should say, and they're willing to pay for that. So we're seeing fairly substantive key money, especially in full service deals, which are the most difficult to get done from a cost perspective and a new construction perspective. But yeah, I'm seeing some numbers in key money that are really substantive, not as much for new development, but also to keep on their roster expiring franchise and/or management deals.
Makes sense. David, Dan, any last words before we wrap it here?
Yeah. I mean, we're financing a good amount of construction right now, but every construction project has a tariff problem, and it's lenders are being very selective, and we're finding developers, in spite of the fact that their business is developing, they're also being very selective.
Just self-limiting, really hard to do. The best projects, best sponsors are going to get done and nothing else.
Yep. Well, cool, guys. Hopefully, in light of that muted supply, it translates better to some additional ADR growth in the next 12 to 24 months than what we've been living year to date. So that's a hopeful view anyways. Evan, Will, Dan, David, appreciate your guys' insight and perspective here today. Always a valuable conversation, and really appreciate you carving out the time for the audience. Hope you guys found the conversation helpful and interesting, and look forward to touching base in the near future with all of you.
Thank you
very much.
Thanks, guys.
Take care, guys.
Thank you for having us.
Thank you, ladies and gentlemen. This does conclude today's call. You may disconnect your lines at this time and have a wonderful day, and we thank you for your participation.